So I guess we're live, right? Hang on. Meeting is now streaming live on. Okay, so yeah, we're live, folks. Welcome to TPP 23, January. Rubbing off the Christmas stuff. It's hard work, but we're managing it. So welcome to the first live TPP. Over to you, Sharon. You're in charge, so give us a little intro. What we're doing.
Thanks very much, Dill. Yeah, today we are welcoming back Akhil Mehr from our mortgage broker. Akhil Mehr he's the managing director. He's got extensive experience in the UK banking, corporate finance, and residential and commercial mortgages since 2002. He's a seasoned property investor, and he's bought and sold property pre and post the 2009 financial crash. Akhil launched the mortgage and property finance brokerage in 2018 as a one-man band, and he had a very clear vision and goal for his company. And he's very proud right now to state that they are heading in the right direction with the continued support of their clients, stakeholders, and their lending partners. Working day and night to be the most impartial, experienced, and impartial brokerage in the UK. Our mortgage broker, a team of 8 fully qualified CMAP advisors, and they've got a big vision to further grow internally and externally. As impartial, discreet, and qualified advisory team with over 100 years of experience combined, their professional team can advise and guide you on the best way forward, and they offer a wide range of financial services for a variety of purposes, including short-term finance and bespoke financial solutions for both residential and commercial clients. They're an award-winning brokerage, and the London and Home Counties SME News Finance Award have said they're the most innovative residential and commercial mortgage broker. So welcome, Akhil. Be good to hear from you on what's the latest figures around the housing market and just generally what's happening.
Yeah, well, thank you for the warm welcome, and it's nice to be back on the TPP show. Are we still allowed to say Happy New Year? Well, what day are we now?
I reckon we could carry on saying Happy New Year till end of January 24, right?
The key is that let's hope it remains happy, because we've had a turbulent last 3 or 4 months of 2023. 2022, I should say. So it's been turbulent. There's been some ups, there's been some downs, but the good thing is that interest rates appear to be on the way down, which is nice to see. So so thank you for your kind.
Hang on a minute, mate. Hang on a minute. What makes you say they're on their way down? Come on, that's
okay.
I'm missing something.
No, I like it, and this is what this is about. So we're here to provide information on the UK housing property market. We're all in property. We do this as a business, as a workplace. So we're advising all types of clients, whether they're first-time buyers of new homes or portfolio landlords and everything else in between. So the reason why I believe interest rates are on the way down is because data doesn't lie. If you look at, and I always say this, is you must view the US swap rates, and in particular the 2-year money and 5-year money. The Q4 of 2022, the curve went dramatically upwards. And for a mortgage borrower, for someone that's holding debt, that's not good news, because what that means in simple terms is banks have to go to the money markets to borrow money in order to lend it out to you to buy your home or a buy-to-let purchase. The cost of those funds rose so dramatically because of Liz Truss and her team after their mini budget or explosive budget announcement. Just before Guy Fawkes, I remember. So data's not lying at the moment. The cost of funds in a swap rate market is coming down. They were heading sort of 6 and 7%. Now they're floating between 3.5, 4.5, depending on which year you look at. So that goes to show that the money market, which is the most powerful money market in the world, because that's how money exchanges hands between you and I, country to country, bank to bank. So they're the money markets that you need to be keeping an eye on. And that data is showing us that the markets are having more and more confidence in the local economies in each of the countries, and also the banks are getting more confident in lending out money. Like we had with COVID, we had a big, massive explosion of lenders pulling rates off the table. They reduced the amount of products that were available, just simply because there wasn't a financial crash occurring. They just wanted to redeploy their staff, manage their existing pipeline, and redeploy their staff to work from home. The same thing that we've seen in Q4. Again, this is not a financial crash. This is, a huge disaster in the financial economy because of people's saying and doing or preempting things that they want to do. So it's a good thing to say. It's a good thing to see money markets getting more appetite at lending to one another. And the US swap rate is a good barometer to use to think where interest rates are going. So
Akhil, can I just can I just ask, sorry to interrupt you.
Please.
Can I ask you, how is inflation affecting everything you were saying? How does inflation affect the swap rates and also interest rates?
Yeah, sorry, that's a great question, because I was just looking at that. I think the release figure was yesterday 9.2, so it's come off the 10 mark.
Okay.
And one of the reasons that the Bank of England is raising the interest rates is to dampen inflation, as they would put it. So, Akhil,
that's right.
Any comments on that?
Yeah, you're nail on the head there. Now, inflation is double digits, whether it's 11, 10 or 9 now, it is what it is. And Bank of England have got their own way of monitoring it and how they assess what the inflation rate is. I actually, if I look at my local economy, I look at is where I spend money, the cost of filling up cars is a lot more expensive than it was 12 months ago. But if you compare it from 3 months ago to today, the cost of filling up was £150 for my car, and now it's 120. And
Exactly.
I filled it up a couple of days ago. So the cost of doing things, depending on the time frames that you're looking at, is actually coming down. If I look at it from a 3-month period, if I go back 12 months, it's actually costing me more money. But that's like anything in life. Usually everything costs more as we get older. But from an inflation stance, inflation has been growing for many, many years. And the years, I mean, is the last decade. There's been slow increments in inflation, not just in the UK, but for globally, of inflation going up. The biggest cause for inflation is the amount of quantitative easing that the government pumped into the economy artificially. They pumped in more money during COVID than they did in the financial crash, which is a massive, massive explosion. Basically, they pumped in too much artificially, which now means they've now increased inflation. The knock-on effect of inflation, there's a bit of Brexit, there's a bit of Russia and Ukraine, and there's a bit of general inflation in cost. Because we've been in a low interest rate market, everyone's had surplus rental income, surplus income that they've received to then go out and spend money. So everyone's been spending. So what the government want to do now is raise interest rates to, as Dil said, dampen inflation, to stop people going out and buying fancy items and going on luxury holidays to combat inflation. So high inflation is not good. But some people argue high inflation environment is actually good for UK real estate property because that bumps the house prices up. So everyone, I always say, in any disaster, any pandemic, any recession, there's winners and losers in every situation. It's just where you are in your journey in your life.
So as my old economics teacher used to say, and this is on inflation. So the Keynesian view is, sorry, the Friedman free marketeer money view is that too much money chasing too few goods, right? So that's why prices go up. Because if you think about it, you only had 2 pizzas, you had 50 quid, there'd be 25 each. If you had 100 quid and you only could buy 2 pizzas, there'd be 50 quid each, right? So that's the general principle. Now, in terms of property, can I interrupt you there?
No,
but go on.
Is that this particular inflation is not caused by that Keynesian, because, I kind of understand some of that too. It's been caused by the monetary side, by, like Akhil said, by the overprinting of money.
Oh,
right?
no, so there's a couple of reasons.
So what's happened? Yeah. Oh, sorry, carry on. But I just wanted to point that out. It's more so because of, the increase.
Yeah. So I remember sitting on a number of Zooms, some of them with Akhil, sort of March 2020, and we were all expecting a property crash or a correction, as people would put it politely. And suddenly, because the government printed all this money and everyone's sitting at home with no gardens, they thought, listen, we need a house with a garden so we can go out and walk the dog and work from home and all of this stuff. So what do they end up doing? Paying extra money, sitting at home, just buying homes off the internet, like buying them from Amazon. And I remember watching people pay 50 to 100,000 pound extra for the same property a year before. So between March 2020 and pre-Liz Truss, I think we had 20% rise in the markets. Partially, part of that was the government dropped the interest rate. So there's a formula that the economists use where it's price divided by rate, and that gives you your asset, the return, and the return was higher. Anyway, there went this rampage 20% increase, and then there was a stamp duty nonsense as well. But tying it up with inflation, there was what they call an external shock. You know, in the 76, around the 70s, they had petrol prices going up. We had this with gas from Ukraine and the Russian war. So that impacted, yeah? Now, there's one in, I'm going to connect all this inflation stuff to property. I remember my old economics teacher, Mr. Thomas saying, and he was a teacher, and he said, look, inflation is good for me. And this is an interesting idea. So at that point, you could get a house for God knows what, and you had a £30,000 mortgage. That was people's mortgage, right? That's the dark ages, yeah. Anyway, so you had a £30,000 mortgage. He said, look, inflation, and he'd just been out of the 70s inflation shock. And he said, look, inflation's great for me because if I've got a house and it was about 45,000, my mortgage is 30,000 and my wages are, I don't know, 20,000, right? If inflation goes up, my house price is going to go up, my wages are going to go up, but my mortgage is still going to stay the same. So the value of debt diminishes. It's what Robert Kiyosaki calls good debt. Yeah. Yeah. So nobody likes inflation, but there is an aspect to it where it can work for you, and for property investors, it works for them. Yeah. Also, there's a point of inflation. I don't know if you remember, there was a period where it was looking as if inflation was going to become negative, and the Bank of England really panicked then, and you've seen it in Japan. So, and I think they're predicting that in a 2 years' time or so, it's going to go to negative inflation. Any thinking on that, guys?
Is that stagflation?
Stagflation is when you have no growth, but you still get inflation, right?
Right.
Negative inflation is seldom seen. I think it was in the 60s that they had some of this, where prices are dropping, but nobody goes and spends any money. The economy sort of stalls because everyone's thinking, well, why am I going to spend it now? It's going to be cheaper next year. Yeah. That's the effects of negative inflation.
Yeah. It's the thing is, we've been there before. You know, history always repeats itself. You know, Dil, you probably remember, I know you're not that old, but in the 80s, interest rates were 12, 13, 14%.
15%. Black Monday, well, is when they tried mucking around with the predecessor to the euro, right?
Yes, yes. So what happens is, it's like, you know, history always repeats itself. I hope we don't have interest rates at 12, 14%. I really don't. I really don't want that. However, what goes around comes around. We've had a decade of ultra low, basically zero interest rates, right? If you took advantage over the last 10 years or so and you got rates at 1%, 2%, well done. I tell my clients, well done. You took advantage, you know, you extrapolated the cash out of your portfolio, you reinvested it into further property, you've gained through COVID, as Dil said, house price inflation during COVID. People thought we were going to see a massive shock in the property market, but the shock was actually good for owners, not so good for buyers. So the last 3 years, actually the last sort of 7-8 years, has been it's been a seller's market in terms of getting higher sale prices. But tables have now turned, right? You've got a high interest rate market, means cautious buyers, selling prices will fall off a tad, but it's always it's all to do where you are in the country. Regionally, house prices will do better than others. Naturally, it happens. We're still seeing certain parts of the country, including Scotland, where house prices are still extremely low or negative since the disaster in 2009. So I think when people are looking at the housing market, they shouldn't just read the headlines. They need to look beyond the headlines and understand, what does property look for them? Where is a real return on investment rather than property yield? It's cash on cash investment is the key ratio that I always suggest people to look at, because that's the real barometer to go by. Do I think house prices are going to come down? Well, you know what? I think they will come down, but they're not going to come down from 100 to 50 pounds tomorrow. Certainly not. And the reason why I say that is because employment is still very, very low, which is a good thing for the economy. House prices are still very high. And the other biggest factor is the amount of property to go around is just not enough. And this is a legacy issue in the UK. We're not building enough property. We've got cost of materials going up, labor force is deteriorating, whether it's because of Brexit or not. I think it's not, because people were leaving England to go back to other parts of Europe prior to Brexit because they made their cash. So there's lots of variables that play into every scenario when we have a turn in the market cycle. But it's like anything. I always say the best form of investment is not property. It's actually self-education, because you can't go out there and buy real estate property thinking you're the guru or you think you're the don without having knowledge or expertise or advise sensible people to advise you. Because it's not like going to Amazon and buying yourself, I don't know, a toy car, right? So education first, then research of the investment property or your new home, and then be picky and choosy around where you want to live. You know, is it transport links? Is it schools? Is it working from home? Is it, you know, the transport going into London, for example, or major cities like Birmingham, Manchester? So there's lots and lots of variables. And also, for example, we get tons of phone calls each and every week where clients ask, you know, is now a good time to buy an investment property? Well, my honest answer is, if you're questioning yourself, it's probably not, because I can't force you to buy a buy-to-let property, nor do I want to. So if you're questioning it, it's probably not right in where you are in your journey. What I can do is provide you with factual information. That could be, you provide me with the property that you're looking for. I will assess the numbers for you, and then you can make a decisive decision whether the numbers make sense. Because as investors, if the numbers don't stack up, i.e. pay for the mortgage, cover the estate agency fees, if it's an apartment, servicing ground rent, and it produces some sort of income in the background, if it doesn't, then it's not going to be a good deal. If it does, it's a potentially a good deal. And likewise, I always say to clients, you know, they always ask me, what's the best way of adding value to a property immediately? And my honest answer is by adding bedrooms. The more bedrooms in a property you can add, that's where you're going to get the highest rate of return. So you don't need to worry about my property value is doubling every 10, 15 years. You can actually add 10, 20, 30% to a property if you use permitted development, or you go down the planning route and obtain planning. So there's loads of ways of still making money in property. But again, self-education, doing good quality research and taking relevant advice from property professionals like you guys and ourselves at Our Mortgage Broker. And it's a long game. Property is always a long. The problem, I think, today's world, especially this new generation, is I want to get rich quickly. And my answer always is, you might get rich really quickly, but how long can you sustain that wealth? And what are you going to do with that wealth? Because usually there's a saying, right? Easy come, easy go. And I'm a big believer of that. So real estate is always a 5, 10, 15-year hold and reinvesting the profits back into the property or further property. So, you know, there's always, you know, they say there's different, many ways to skin a cat. Same with property. There's various ways of adding value to property. It might not just be a single family let. You might want to convert it to HMO. Or if it's in Cornwall, Devon, you might want to consider service accommodation, holiday let, which then increases yield. So even in a high interest rate market where now limited company rates are not 3% anymore, now they're at 5%, yes, payments are going to 50% increases or whatever it is. However, is there ways of combating that or hedging your rents? Continue to go up. So even if house prices come down, rents are going up, which actually is a big beneficial to property owners, because when rents come down, when house prices come down even and rents continue to rise, it helps with yield. Therefore, your return on your investment's higher, and also from a buy-to-let stress test allows you to borrow more money. So that's a great opportunity there. The other opportunity here now is, as I said, in the last 3 years, it's been a seller's market. Dil, you mentioned people were buying 50, 100 pound, 100,000 over the askings. There were queues for viewings. We've all seen it over the last 2-3 years. But now we've moved into, and I said this about a year ago on another channel, we've moved into a seller's market where people thought we're still in a buyer's market. So we moved into a seller's market basically 12 months ago today. So now's the time to negotiate every single opportunity where possible. So if something's on for 300,000, your opening bid should start with basically how educated you are and what your investment, because you might think it's worth 300, but I say no, it's 275 all day long. But it's who's got the best idea in terms of, I can convert the property, I'm going to get a better type of tenant, or I'm going to add value to a property. So you've got to do your homework prior. So certainly for the viewers out there that are watching this, you'll feel free to contact me anytime. We've got a team of advisors. Don't just do property finance, but we like to consult with our clients and guide them where possible, and the best possible approach. And also, as I said, negotiate. Now it's a seller's market. Take advantage of negotiating the purchase prices.
So, Akhil, a couple of points there. Education is one of the reasons we do this channel and all these interviews, is to help our viewers educate themselves. So thank you for that plug. In terms of what your property strategy is, one of the things I've heard someone say, and I think this is actually true, where you've got a down market, i.e. the general trend is heading downwards for the shorter term, that's when people are more flexible in the deals they'll consider. You can do creative deals, the offers, and so on and so forth. And there's not so many people queuing up for that property. That's a buying opportunity. Now, and something else you said, very interesting. I actually haven't heard it expressed like this before. If you're having to think or question yourself, that means in your particular property journey, it might not be the right time for you to have another deal. So
100%.
That's 100% correct. And you've advised a very close friend of mine, and you gave him absolutely spot on advice. So Akhil knows his stuff, and as a result of Akhil's advice, he was able to. He was in a bit of a tight spot. He was doing a development. He was able to get himself out of that. So thank you for that, Akhil. Now,
no, pleasure.
Yeah. So we in terms of as part of my job, I talk to property guys every day. People who've got property, people developing. Had a really interesting conversation with a chap from Watford last week. At the beginning of this week. He said he sold his buy-to-let property in November, and for some reason he timed it perfectly, right? So this got me really thinking. He said at that point, before he sold it, his mortgage was 1,050. By the time he sold it, it went up to 2,100. At the moment, it's costing the current buyer 2,400. The rental he was obtaining for that property was 1,750. So if you look at those figures, you're seeing the effects of, and what we've got is a lot of people are on fixed rates, right? The impact of these interest rate rises aren't going to be as quick as in previous years. I think there's 1.4 million people that are going to come off the fixed rate mortgage this year and have to remortgage.
Yeah.
So, although the bank rate in England's raised it really fast, it's going to have longer time to impact that. So, and look, interest rate rises are horrible for people who just own their own home. It's getting ridiculous out there. Cost of living, all of this. The problem we have is, as consumers in the UK, we tend to ignore the bad news, right?
Yeah.
Okay, the money's coming in. I can carry on affording. I'm going to go and buy some more stuff, more rubbish off the internet, right? I'm going to go and have a bigger house. I'm going to do something stupid with my money, right? And trust me, I'm the first in the queue when we do all of that nonsense, right? I'm going to go out eating more and all of this stuff, right? But when the mortgages go up and you realize, I haven't got any money left, and this stuff's going up, I better cut down. And the point I'm trying to make is I'm just looking at the interest rate chart. It's the people haven't known interest rates at 4-5% since about 2007, 2008. And if you really sit there, think about it, that's 12 or 14 years. It's sort of almost gone out of people's memory saying, well, interest rates have always been 1% and 2%. Who's this 5-6% nonsense come from, right? And suddenly now they're going to get hit by 5 or 6%. I think there's going to be a delay in people in that pain, and it's going to probably carry on for 3 to 4 years. Any views on that?
I certainly believe. Okay, so you hit on so many great heads there. So yes, there's over 1 million mortgages coming up for renewal this year. So that goes to show, in the grand scheme of things, it's still a very small percentage that it could be worse. So a lot of our clients fixed for 5 years in the last 3 years. So they're on good money, good rates at the moment. But yes, you're right. Another 1 million people are going to come off fixed rate deals who are paying 1, 2, and 3, and they're going to have a shock to the system. But they took advantage of the time when the time was right. Now, the UK average interest rate for base rate is usually hovering between 5 and 6% as a norm for many, many decades. So it's an artificial where we were for the last decade. But you're right, no one has seen changes, and people have got used to having that spare income and paying low interest rates. So it's going to be a bit of a culture shock for everyone that's coming off fixed rate deals. But like anything, you will cut back on those restaurants, you will cut back on the holidays, you will tighten the belt because you don't want to lose your roof, right? So there's always ways of everyone can reduce their overheads, the uncommitted stuff, if they really wanted to, the gym memberships and the alike. So there's always ways of doing things. It's just people don't like change, but the sooner they get used to what's happening, it won't be such a serious shock when it actually happens. So now's the time. We tell our clients all the time, share your property portfolios with us. Can we do things for you now? Can we plan ahead for you to combat any rate changes? Or are you sure that you're on a fixed rate? Because I've had many, many clients think they're on fixed rates, but they're actually on standard variable rates or they're on tracker rates. And then they've contacted us because they've had a letter come through the post to say the interest rates jumped up to 6-7%. So I say to everyone, please keep checking your numbers. Check with your current mortgage lender to understand when is your mortgage coming up for renewal. I tell everyone, if anybody's got a mortgage coming up in 2023, you need to contact us. Speak to your company, your bank, or speak to the likes of us, our mortgage broker. We'll happily look into your mortgage deal with the current lender. We'll access the system on your behalf, and we'll see what your current value of the home looks like, the outstanding mortgage. Can that lender provide you with a new product today rather than waiting? Every lender has different options available to them. But if anybody's going to take anything away from this, is a couple of things. Is one, education is key. You've got to remain educated, especially in such a volatile market. And also look at the numbers. Make sure you do check when your mortgages are coming up for renewal. It only takes a few minutes, and everyone should have sort of smart, savvy Excel spreadsheets or notifications on their phone when mortgages are coming up. And I'm very OCD like that. I have a note to say your MOT is due next month, and I'll just put it in every 12 months, whenever it is. So things like this, people need to get more and more efficient. And I think rather than timing the next episode of Harry and Meghan in your diary for Netflix, Phil, put in the calendar the date for your mortgage renewal.
Yeah. Spend as much time watching your mortgages as you do watching Harry and Meghan, right?
Yes. And I've got nothing against Harry and Meghan. I think they're lovely people.
Of course. No comment.
Yeah. So, Akil, I'm just reflecting on what you're saying. So, provided we don't go back to what happened with Liz Truss when we had this liquidity crisis, when all the lenders withdrew products, unless something like that happens, we're okay. There's plenty of liquidity in the market. So in terms of mortgage products.
No, you're 100% right. So there's a couple of things I want to touch on here. When we had the 2009 financial crash, the banks did not have enough. They didn't have enough in the bank to cover. They didn't have enough to cover a storm. So basically, if a storm hit, which it did, the banks didn't have enough monies in reserve to combat that storm. That was a problem, but that was a regulation problem because the regulators and the governments for those countries, or every country, didn't enforce measures for banks need to keep 10, 20, 30% in reserves. Hence why Basel 1, 2, and 3 came out thereafter. So banks have to be liquid to a certain degree on their balance sheet, just in case for a safety net. So it's like having an overdraft. Or no, it's basically having a credit balance rather than a negative balance, so you can weather any storm. Now, there's certainly not a liquidity problem in the market because banks are very liquid because they are very liquid because the money markets have been very generous to them. So the affordability of borrowing and exchanging monies for mortgages and bonds has been very lucrative. So there's a couple of things there. So I cannot foresee a financial disaster, but what I can foresee, and everyone should be at the edge of their seats, is it only takes one person, one government in major Western parts of the world, actually even Eastern as well, right, to say something wrong or tweet something wrong or Instagram something for the world to go mad. We've seen it with Liz Truss. We've seen it with other huge nations out there. One person says something wrong or sneezes, like the US, and I've said it many, many years. If the US sneezes, everyone catches a flu. And basically the moral of the story is that if it can go wrong very easily, but everyone just needs to time any news at the right time. So I think what Kwasi and Liz had in mind was actually a very good plan. I won't go into the details. I don't know too much about it, but I'm confident in saying their plan was actually very, very good. Where they fell down, and they fell really, really badly, was the timing in the market. Number one, the timing in the economy. That's number one. And also, they didn't speak to the money markets. They didn't explain their plans. They didn't ask them for their opinions. Therefore, it caused a rupture in the market because the market didn't expect that announcement. And if the markets don't expect an announcement, that just means turmoil for borrowers and the swap markets. So I'm confident banks are very liquid. We get updates from lenders every single day of the week. They're begging for business. They're in the market to lend. But most important thing to take away from the lending side is they want to lend responsibly. And that's because of 2009. So that's good for the borrower. So they're not stretching themselves. The stress test for buy-to-lets is actually a good thing because they were stressing at 5.5%, 6% interest rates anyway. And we're here now. So what that means is if it was affordable then, it's still affordable now because they've already warranted that stress test ahead of time. So banks and the PRA regulation have actually done us a favor because they've preempted a disaster like this to happen. Interest rates were actually always going to be going up, but no one expected them to go up so sharply.
Akhil, I'm sorry, buddy. I'm going to have to pull you up on this one.
Please go ahead. That's what we're about.
Liz Truss and Kwasi Kwarteng really bungled it, right? So first of all, trickle down nonsense doesn't work, right? Secondly, they got rid of the budget Office of Budget Responsibility and didn't even show them their plan. Thirdly, they got rid of a treasury guy whose job it is to communicate and there's no oversight. So basically, they said, we're going to go and spend all this money and we're not even going to think about how we're going to pay it back. It was the wrong time of the cycle in the economy.
Exactly.
And had there been a banker like Rishi was, they would have known how this stuff worked, right?
And he said the same thing when they were having their debates.
He actually said it on his bid to become PM. He said, look, you're going to muck this up. And what did the Conservative membership do? Said, oh, hang on, we've got another Margaret Thatcher. Let's vote for her. And then, unfortunately, we all suffered for it. So, it's great. It's great having a fantasy idea, and we all want to grow and be rich. But if you're talking out of your proverbial and you're bungling the execution, then you deserve whatever's coming to you. I don't know what's going to happen to those two, but it's like, come on, have some sense. Grown up, you want the grown-ups in charge of your government, not those two idiots. Yeah,
it comes back to education, doesn't it? It's
unfortunately, those two had an education. At least, who's a black damn barrister, right? But relevant education, right? So Rishi Sunak was a banker. And Hunt was known for being prudent. Those guys know what the money markets think. You could have a great education. I know people with brain the size of a planet. They can't string a sentence together.
Yeah, no, it's key. And you're right. It's all about education. No, you have to be educated, but you need to have common sense as well. Common sense is not common. And also, it's about, what worked yesterday might not work tomorrow, but you can foresee that. And you've got qualified advisors and advisory accountancy firms and all that sort of stuff to give you the relevant advice. So, it goes back to that thing. If you're unsure, ask for help. If you're a first-time landlord and you don't know where to invest, do your research, speak to the local professionals, local agents. It goes back to education. And if today's not the right day, don't rush it. Think about it tomorrow or next year or whatever it be. But, I always say, don't rush this. We can't afford to rush into anything in this day and world, because when you get it wrong, it goes really, really bad. And there's something called the internet, and, it's not nice for your own confidence as well. So I would say, don't be rash in any decision, and especially in a volatile market when anything can happen tomorrow morning.
Yeah.
Akhil, sorry. The internet only works when you put enough 50p's in. I thought I'd tell you.
Yeah. and what you're saying, Akhil, I think it's absolutely right, because I was reading a report by Lloyd's, which is saying that we're entering the longest recession on record. And so, that's I suppose what they're saying is the economy is going to contract, right?
Yeah.
Okay. So the hang on. Wait. Let's do some predictions for 23. Akhil, you go first.
Okay. So I'm going to put some context around it. Yeah. Every single media outlet have their own agenda. They're owned or invested by certain people, and they have their own agenda to put it out. I'm not disagreeing with what the mainstream media say. But what I would say is, listen to it, absorb it, but make your own opinion of how they're coming across or what the reality is. Because some people, if you go to major private member clubs in London, all the expensive Michelin star restaurants, I bet you
like the ones you're a permanent member of, right?
Yeah. So I bet you can't get a reservation just simply because they're inundated with members and visitors.
Two members are here already. You're our group.
There's a winner. There's winners and losers in every situation. Yes, everyone's got different sized pockets, and I appreciate that. But I don't believe everyone will feel a pinch in their pockets. We're seeing it clearly in petrol prices. Going to the supermarket, everything usually does go up, and I appreciate that. Cost goes up, rent goes up, everything goes up. But Germany is the biggest economy of Europe. I don't know what, I think it must be the chancellor or the financial person in Germany said Germany won't see a recession. And if someone as powerful as Germany are going to say that confidently, and I was listening on Bloomberg, because I listen to that every day I'm in the car, they confidently said Germany will not face a recession. And if they're saying that, then everyone else in Europe should not feel a recession. However, it goes back to it. Every country is like a different human being. Everyone will feel different recession or different pinches in their own bubble, because we've all got an economy within our families. So within your own home, we are an economy. And I always say, I put a post out on one of our social media channels the other week, and I said, don't worry about the world's economy, because you can't solve that. What you can solve and try to keep under control is your personal economy within your four walls. You can reduce overheads, costs, and rather than going to Waitrose, you might want to go to Lidl and Aldi. Other supermarkets are out there as well, but you might want to consider those. And apparently, Lidl and Aldi do really good fruit and veg, but they haven't got one where I am, unfortunately. But
so you have to carry on using Waitrose, right?
Yeah.
But the point.
Thank you. That's really great, actually, and I think that's so relevant. Yeah.
Okay, how's prices in 23? What are they doing?
Okay, I think the first half of the year is going to be the most challenging. So if you're selling a house, you might take a little bit of a price drop.
How much?
It's good for the buyer.
How much?
I think. Okay, so if I look at Southeast, so Watford and home counties, M1 down, I honestly think a 5% reduction at the top end. Okay. So the seller is actually not really losing much, because he's probably gained a 20% increase in the last 2 years anyway. He or she might not think that, but they wouldn't have seen that 15% gain if COVID didn't turn up. So that was actually a blessing for homeowners. So I think a 5% decrease in the first half of this year. I think inflation will chop in half or thereabouts in the second half of this year, and cost of living will decrease as well. So I think we'll stay steady for the remainder of 23. So I think we'll have a price increase, maybe not at 10%, but we will see a positive price increase in house prices.
Okay, Charanjit, what do you reckon? Your turn.
I think what you said before is, it's like, I think London's got a very different economy, hasn't it, to the rest of the UK?
Yeah.
And we're all based in London. And I think that London, you've got to also look at the, house price to earnings ratio. And in London, that's got completely, the gap's hugely widened. So I think, you know, it's also a question of where you're buying. And my understanding is outside the UK, it's a very, I mean, outside London, it's a very different kind of market.
Yeah.
As well. So I think there's a number of...
London will always feel the pinch first, right? It's the capital.
Yeah.
Every capital feels the pinch first. If it's going to go down, it will go down London and then trickle outwards. But when the market starts seeing an excitement and a boom, the London will see the boom first, and then the rest will follow suit. And the other thing is, prime real estate in London, so I'm talking zone 1 and 2 in particular, zone 1 and 2 in London, where house prices are 5, 10, 20 million pounds, it's good for cash buyers. It's actually good for foreign investors because the UK pound, the sterling GBP, has taken a battering over the last 3 years. You're getting pound at 30% discount if you're comparing USD to pound sterling. So the guy that was going to buy £1 million house in London is now costing him 700 because the pound's taken a dump, right? So so it's fantastic for the investor from abroad. Maybe not for us locally, but again, you know, it helps.
True, and you've also got to look at the annual growth rate. So, you know, prices might not be growing as fast, but they're just growing slower, right? So the annual growth rates.
Technically, we're not in a recession yet, actually.
Yeah, you need 3 quarters in a row.
Two quarters in a row of negative, and I think December just escaped by 0.1%, although those figures are always revised. Thanks to the World Cup, right?
So before I ask you, Dil, for your opinion, why do we need to wait 2 quarters, 2 months to say officially we're in a recession? We are in a recession. Cost of living is spiked. Inflation is double digits.
No. Sorry, mate. Sorry, dude. The definition of a recession is 2 quarters of negative GDP.
Right. But why, as local humans, we should understand we don't need Sky News, BBC News to tell us we're in a recession because data's come out 2 quarters in a row. We should be proactive as humans, and I do blame our schooling system for this. Our schools don't educate the children. I'm still a child. I have 2 boys. Our education system doesn't teach them about balance sheets, P&Ls, what to look out for, what to be proactive with, where to invest, how to invest, and blah, blah, blah. That's the problem, and it's a legacy problem. But it's up to us as parents, as leaders, or as educators, whatever you want to call us, to do things because you've been around the block. You don't want your kids and your loved ones to see those disasters. So how do you preempt that? So the best way of preempting it, go on, sorry.
Is my view. I took my mum to the doctors a couple of weeks ago. Really interesting conversation. So she was at school about 55 years ago in India.
Yeah. And
she said, I don't understand why people aren't taught budgeting. This is 55 years ago in India. They were taught budgeting, how to budget your household expenses, right?
Yeah.
You don't get anything like, I mean, forget P&L investment, all of this. And Rishi talked about teaching maths till 18. The only thing they need to teach kids is how to understand their household budget. And I have a theory why they don't do it. So I'll tell you why they don't.
They want you to spend.
Exactly. It's bad news for the bankers. Because if you knew how to budget yourself, you wouldn't go into debt and make the bankers money. Right? All they need to do is teach kids from 12 to 16 how to understand a household budget. I get paid this much. I can spend this much. I've got to go and save up for my Apple iPhone, or I've got to save up for X, Y, Z. And that way I don't have to pay they don't even understand interest rates. APR, people don't understand that. You've seen it. So why is that education system gone backwards in the 50 years? There's only one reason. Thank you, Mr. Banker, making us economically illiterate so we're always in your debt.
It's their own agenda.
There you go, right? So anyway, what's going to happen this year? I think it's going to hurt a lot, right? And I do agree that news is negative in the main. I try not to watch it because it's bad. It's bad for your mind, right? Bad for your spirit. But negative news captures your attention twice as much as positive news. That's why you might get one positive story in half an hour, if that. Unfortunately, we are going to get kicked really hard. House prices are probably going to fall at least 10%. But we're looking at, if we look at March 2020, we've had a rise of about 20%.
Yeah.
That's going to get reversed reversed probably halfway. Now, within any property market, there's also a spectrum of submarkets. Yeah. And unfortunately, although I hate this, what I always see is the nice, pristine, done-up houses sell the fastest, fetch the most money. Whereas the ones that have the best potential, and I think this is why some of the houses are unaffordable now, because people want nice, shiny new flat, everything done, move in, switch the telly on, we're ready to go. But what happens to new build flats? Their price lowers over the 10 years as they become not so new, yeah? But there's a lot of people who want to buy new stuff. Whereas the value in property is the stuff that needs doing up. And that's where your bargains are going to be. And those are going to be the ones where you can have probably the most impact. You'll get the most deals, and they could drop at least 20% over the next 2 years. And I don't think this recession. The other thing I'm thinking about a lot is we're talking ourselves, and it's the old phrase, we're talking ourselves into a recession.
Yes.
That's all you hear on the news. It's a recession. It's a recession. And the reason it's going to be the longest recession, and there was something interesting podcast I was listening to. This was a lady who ran a dancing school for kids, right? And she said in the previous recession, parents cut back on a lot of other stuff, kept their kids coming to the dance school or whatever treat they're doing, until about 2 years later when they'd cut back everything else and then decided, because they wanted their kids to have a sense of normality or try and do something positive for them. And then they were cutting back those treats sort of 2 years after the recession. And I think that's the pattern you see. And the memory of those recessions lingers in people's mind. Now they're going to see 5 and 6% interest rates after 12 to 14 years. When people see that, they're going to have that embedded in their mind for the next 20 years. So that's the effect you're going to get. I could be wrong, but that's just personal view I've got. Listen, I hope people budget for 5 and 6% and use the money to save some money, right? Use the difference when the rates get lower to save it, and not overspend on buying houses with a bigger garden, spending 50 and 100 grand extra.
The problem is with saving, the problem here is if you save, you're not going to become wealthy. You have to invest.
I agree.
By putting money in the bank account, because what's happening is you put £100 in your bank tomorrow. Yeah. They might pay you 0.1 or 2% now, but they're lending it out at 5, 6, 7%. So they actually just basically banks are quite a bit of a business in themselves. They're not doing you a favor. You think they're keeping it safe. They're giving you insurance of £85,000. Anything goes wrong, you're insured. But what they're doing is they're actually telling you we're taking your money elsewhere and we're investing. And it's just siphoning the money around the cycle. Yeah,
I agree. But when I say save money, I mean as opposed to living beyond your means. Have a rainy day.
Yeah, no, I get it. No, it's true. And yeah, of course, everyone shouldn't be living beyond their means. Now and then treat yourself, if you want to, whatever, I get it. Everyone wants to enjoy and splash the cash now and then. But I just think that, especially in today's world where everything is all on social media and it's all glam sham and all this sort of stuff, and everyone thinks that they need to show off, I think people need to hone that in, just simply because people might say, well done, looks amazing, but they'll forget about it. So I think the quicker, especially this new generation, are buying these prime drinks. They're £2 retail. I think people are buying them for £10 and reselling them, which is actually quite good. So if you're reselling it, you're making a profit. That's really good. I know
prime drinks. Is that new discovery you've made for 23, right?
I wish I did, but it's a couple of YouTubers they've got their really big influencers, and they create this drink called Prime. So I think Asda are selling it for £2, but there's other retailers out there reselling it for 5, 6, 10 quid. So it's a business, but that's where people need to become entrepreneurial. And I tell my kids the same thing, there is no trophies for second place. And you must get to grips with real-time economy, real-time living, and just being proactive. And the best way today, you cannot, if someone says they cannot be successful or make money in today's generation or today's times, they're off their heads, because we have something called Google, we have something called internet, we have mobile phones. We can just live off a mobile phone and you can become rich. You can do whatever you want on a mobile phone.
The best source of information today, we have more information at our hands than Ronald Reagan did who's an old president of the US when they launched the space shuttle. In this
Yes.
mobile that costs, I mean, mine's a cheap version. It's about a couple of £100, right? Chinese, yeah. Other brands are available. You've got access to YouTube with more information, more training, more skills on it than the entire history of the human race. You've got to be an idiot not to use all of that. But
And it's free. It's free.
And it's free.
You've had, like I'm not saying everything in Google is 100% correct, but it'll give you a bit of direction, a bit of steer to where you want to go. But it's free. Like, you cannot lose. It's like, if I'm hungry, I'm giving you food. Eat the food. It's free. It's there. It's in front of you. But sometimes
I should do a plug for my new book, right? Not me out.
Yeah, please do.
Yeah.
Show it. What is it? What show is it? You got a book there in front of you?
No, it's a virtual book. It's on Amazon. It's called ATM Thinking. I'll put a plug on the thing.
There you go.
So exactly my point.
There's so much free. Podcasts. I go for walks every day. I just listen to a bunch of podcasts, property related, entrepreneurial, mindset related, lots of things, because it helps me as a family man, a business owner, a team leader, blah, blah, blah. It helps just people grow. Think big and grow rich, or whatever it's called.
Think and Grow Rich, yeah.
It's just very, very simple. I think generally, if you look at the largest companies out there, Amazon, they don't own stock. Uber don't own vehicles. And all these other companies out there, it's a very simple design. But I think as humans, we try to over-engineer things, analyze things for I don't know what. And I'm a good example of that. But that comes with life training, where you are in your journey, who you're surrounding yourself with. But as I say, we've all got good opportunities. High interest rate, low interest rate. Even when people were in a low interest rate market, they still didn't take advantage. So what's going to make them take advantage now? So it's like anything. If you're going to buy an investment property, you've got to think with a business mind. It's a risk. We cross the road, it's a risk.
Yeah.
But you take calculated risks, right?
And also you notice, this whole thing about not owning anything, not having ownership.
Yeah.
The next generation, they're mostly renting. So the demand for rent's going up, rental properties is actually going
So
up.
you're going to go up.
Well, that might be turning around because Netflix is now losing subscribers. People want to buy DVDs. Believe it or not, they want to own the media because stuff. Anyway, that's a different conversation. Look, we've reached the end of our time. This has gone over. Fascinating chat, Akhil. Thank you very much. Listen, everybody listening to this stuff. Akhil walks the walk as well as talking the talk. He's a lovely guy to talk to, but he actually delivers really great information. If you've got a mortgage, I've experienced it firsthand, so that he's helped a friend of mine. Contact Akhil. Akhil, put your details up, buddy. Let's see if we can help some people out there.
Yeah, perfect. If anybody wants to reach out to us, just type into Google ourmortgagebroker.co.uk. It's above here. Ourmortgagebroker.co.uk. Any advice, whether it's for now or tomorrow, just get in touch with us. Pick up the phone, email us, WhatsApp us, I don't know, Instagram us, whatever you want to do. Get in touch. Don't leave it till tomorrow. That's my the only advice I would give. Don't chance it, don't risk it, but don't leave it for tomorrow. If you've got something on your mind, tackle it immediately.
And when you're going to start teaching kids how to be financially astute? When's that program?
Well, I'm trying to teach my kids, think about how you can negotiate, can you think chores around the house to earn £1?
No. Listen, I've heard that idea and people said that's a bad idea, but I do like the negotiation bit. When you take your kids shopping, you say, look, have a go at negotiating this.
Well, listen, at the end of the day, you've got to give them the opportunity. And I think more importantly, sometimes letting your children fail, not intentionally, but you know what I mean? Letting them understand, making their own choices, even though they're going down the wrong route, make them make that mistake, as long as it's not fatal or drastic, but you know what I mean? And then let them learn from that and say, but do you know why you went wrong? Or you were nearly there, but you went left instead of right. So it's like anything. Sometimes it actually makes us stronger as humans, even whether you're 20 or 50 years old. Sometimes making mistakes is actually good because it makes you stronger. The key here is make sure you get off the canvas. It's like a boxer. If you fall down, as long as you keep getting up and trying or learning how it went wrong, that's all we can ask as humans. So, you know what? Don't give up is my another piece of advice. Don't give up. It could be a lot worse. But we live in today's times. We've got these fancy internet gadgets. make use of them. There's plenty of free advice out there. There's plenty of good free advice.
Mm.
And also, if you're going to take advice from anybody, make sure they're proven, tested, wore the t-shirt, because there's a lot of John Jackson Smiths out there and Singhs and Patels, other people are available, that will give you wrong advice or advice that is good for them, but not for you, because you're in a totally different journey, different time in your cycle. So at least get 2 or 3 opinions before you make a decision.
Fantastic advice. And yep, failure is the biggest teacher, as long as it's not an extinction event. Para quality can't bill you there, right?
Sounds good. I'm looking forward to reading your book.
Yeah, I've got to ship it out. It's available on Amazon. There'll be a prompt on it, right? Amazon Kindle, 77 pence. I've kept the price the minimum I can get it down to.
Amazing, amazing. 77 pence. 77. How did you get to that number?
It's $1. $1 is 77 pence according to them guys. 99 cents maps onto 77 pence.
I like it. I like it. Well, there you go. There's always a reason behind the reason.
Right, there you go. Right, so Charanjit, we'll see everybody next week, right? Will we got or is it a surprise?
See you next week. Yeah, thank you. That was great. That was a great discussion. I really enjoyed that.
I like it.
Thank you. Yeah.
Hopefully everyone's taking some value from it. But thank you for your time. Thank you for your conversation, your feedback. I've learned a lot. But yeah, look forward to seeing you guys again.
Buddy, look forward to seeing you soon, and stay off all the bad stuff. But anyway, that's a different conversation, right?
Ciao for now.
Right, ciao. See you shortly, buddy. Cheers. Right. Don't forget to like, subscribe, and share our little debate. I've got to find the off button now. Where the hell is it?